The Federal Reserve in the US is now using supercore inflation to guide interest rate policy. This narrow measure of inflation comprises of the prices of services, for example, barbers, lawyers, plumbers, excluding housing and energy prices. The Fed is paying close attention to services as they tend to be driven by the cost of labor, which the Fed can more easily control with interest rates, whereas the price of goods are more affected by global factors. The focus on supercore is expected to affect the Fed's decision on interest rate increases. In this video, we will delve into the origin, the calculation, and the key numbers of supercore inflation and explain how this data is relevant to you as a trader or investor. If you are interested to get this infographic, check out the link in the video description below. So, what is supercore inflation and its origin? Supercore inflation is a concept in economics that refers to a persistent increase in the prices of goods and services that are considered necessities for a particular population. It's often used to describe situations where the price of essential goods such as food, healthcare, and housing increase faster than overall inflation. The origin of the concept of supercore inflation is not that well documented, but is believed to have emerged in the late 20th century as a way to describe the experience of populations in developing countries who are facing rapid increases in the cost of living, particularly for essential goods and services. This concept is often used to highlight the disproportionate impact of inflation on low-income households and to highlight the need for economic policies that address these issues. So, how is the data calculated? The data for supercore inflation is typically calculated by measuring the change in prices of a basket of goods and services that are considered essential for a particular population. This basket is created based on a survey of household spending patterns and may include items such as food, housing, healthcare, transportation, and education. The change in the prices of these items are then compared to the overall rate of inflation to determine whether prices are rising faster or slower for essential goods and services. To calculate supercore inflation, national statistical agencies typically use consumer price indices, which are measures of changes in the prices of a basket of consumer goods and services over time. The basket of goods and services used in consumer price indices is updated periodically to ensure that it reflects the current spending patterns of households. The calculation of supercore inflation can also be done by private research institutions, think tanks, or economists who use the same data sources as national statistical agencies and may use slightly different methodologies to arrive at their results. The goal of calculating supercore inflation is to provide a more nuanced understanding of the impact of inflation on different segments of the population. So, what are the key numbers measured? In measuring supercore inflation, several specific numbers are typically looked at, including the Personal Consumption Expenditures Price Index, or PCE for short. This measures the price of goods and services in the US economy. Next, we have the rate of change in prices of essential goods and services. So this is the rate at which the prices of the basket of essential goods and services are increasing or decreasing and is an important indicator of supercore inflation. Next is the comparison with the overall inflation. The difference between the rate of increase in the prices of essential goods and services versus the overall rate of inflation is a key metric in determining supercore inflation as well. If the rate of increase in prices of essential goods and services is higher than the overall rate of inflation, it's considered to be an instance of supercore inflation. Next is the impact on low-income households. The extent to which supercore inflation is affecting low-income households is another key metric. This is often determined by comparing the rate of increase in prices of essential goods and services for low-income households versus the rate of increase for higher income households. And lastly, we have the duration of the increase. The length of time over which prices of essential goods and services have been increasing faster than the overall inflation is another important metric. By looking at these specific numbers, economists and policymakers can gain a better understanding of the impact of inflation on different segments of the population and develop policies to address the effects of supercore inflation on low-income households. So how is this data relevant to traders and investors? The data on supercore inflation is relevant because it can help provide valuable insights into the current state of the economy and can help inform investment decisions. Understanding trends in supercore inflation can help traders and investors anticipate changes in consumer behavior, interest rates, and monetary policy, which can all have a significant impact on the financial markets. For example, if supercore inflation is rising faster than overall inflation, it can signal that consumers are facing increasing financial pressure and may be more likely to reduce their spending on discretionary items. This, in turn, can affect the demand for certain goods and services and may lead to changes in their prices. Investors may also use the data on supercore inflation to make decisions about investing in specific industries or sectors. For example, if supercore inflation is affecting the prices of essential goods such as food, healthcare, and housing, it may be a sign that companies in these industries are poised for growth, and investors may want to consider investing in them. Furthermore, trends in supercore inflation can also impact interest rates, which can have a significant impact on bond prices. If supercore inflation is rising, central banks may raise interest rates in an effort to control inflation, which can have a negative impact on bond prices. Hence, data on supercore inflation can provide traders and investors with valuable insights into the current state of the economy, and they need to be aware of these trends and take them into account when making investment decisions. Now, let's take a deeper dive into how each of these different data can affect the financial markets. So here are some specific examples of how traders might use each of the data points from supercore inflation to make trading decisions. First is the rate of change in prices of essential goods and services. So traders can use this data to assess consumer spending patterns. If the prices of essential goods and services are increasing rapidly, it may signal that consumers are under financial pressure and are reducing their spending on discretionary items, so this could negatively impact certain industries or sectors. Next is the comparison with overall inflation. Traders can use the difference between the rate of increase in prices of essential goods and services and the overall rate of inflation to assess the health of the economy. If the rate of increase in essential goods and services is higher than overall inflation, then it might signal that the economy is facing challenges and that consumer confidence is declining. So this could negatively impact the financial markets and lead to a decrease in risk assets such as stock prices. Next is the impact on low-income households. Traders can use the data on the extent to which supercore inflation is affecting low-income households to anticipate changes in consumer behavior. So for example, if the low-income households are facing increasing financial pressure, they may reduce their spending, and this could negatively impact certain industry or sectors. On the other hand, it could also signal to traders or investors that these are investment opportunities in the companies that serve these low-income households, such as food and healthcare companies. Lastly, we have the duration of the increase. Traders can use the length of time over which the prices of essential goods and services have been increasing faster than the overall inflation to assess how sustainable this trend is going to be. If the trend has been in place for a prolonged period of time, it may signal that the increase in these prices of essential goods and services is likely to persist, which could negatively impact the financial markets and lead to a decrease in risk assets. So by understanding the trends in supercore inflation and the factors driving these trends, traders can make more informed decisions about and maximize their returns. So here are my concluding thoughts. In summary, supercore inflation is a valuable data point to keep an eye on if you are a trader or investors. This narrow measure of inflation, which focuses on the prices of services, excluding housing and energy prices, is gaining prominence as the Federal Reserve in the US uses it to guide interest rate policy. So by tracking the trends in supercore inflation, you can get valuable insights into the current state of the economy, anticipate changes in consumer behavior, interest rates, and monetary policy, and it enables you to make better investment decisions. With its roots tracing back to the late 19th century, supercore inflation is a well-established concept that provides a more nuanced understanding of the impact of inflation on the different segments of population. Now that I've covered all about the importance of supercore inflation, is it something that you will add to your trading toolbox? Let me know in the comments below. And if you have enjoyed this video, do remember to like and subscribe and hit the bell notification icon to receive the latest updates. That's it for this video, and I'll see you in the next one.